So if you're deciding how to hold title between community property or joint tenancy, then you may need to consider the tax implications of your decision. Now, most buyers are not aware of the significant tax implications that can cost homeowners actually thousands of dollars. So while one of the most commonly used forms is joint tenancy, many legal experts point out that there are pitfalls that can come with this choice. So we will look at 3 potential pitfalls as well that homeowners make with joint tenancy. Additionally, I'll mention one client bonus that I can provide at the end of the video. Hi, I'm Harold Powell. I'm a local Ventura realtor helping people buy and sell in the Ventura and surrounding communities. Now, one of the most overlooked decisions when choosing between joint tenancy and community property is the tax implications. Now, before we get to that, let's discuss a few things about joint tenancy and the 3 pitfalls to be aware of. Number 1, joint tenancy happens to be one of the most popular ways of taking title, but experts argue for several good reasons that it may not be the best way. When you hold title with joint tenancy, it creates equal interest, and upon death of the co-owner, his or her interest ends and is conveyed to the survivor. The interest in joint tenancy cannot be willed, so the question is, what's the problem? Well, let's take a look at a few examples that can create legal problems and potential mistakes. So pitfall number 1, let's say you buy a house in a joint tenant with your friend or business partner. So again, you're buying the house as a joint tenant and you die. Your share automatically goes to your business partner. By definition, a joint tenant, the last one surviving, takes the property, and nothing would go to you, your heirs, or children. That would be a bummer. So now, pitfall number 2. Let's say, for example, a woman named Mary who's a widow with children. She remarries to a guy named, let's say, Joe. Now, Mary and Joe each have $1 million to put toward a house they buy under joint tenancy. For all cash, $2 million. Mary passes away a year later, and by definition, joint tenancy, Joe gets the property in its entirety since Mary cannot will it or even pass it on through a trust title because it's held under joint tenancy. So pitfall number 3, this happens when a well-intentioned widow or parent thinks that adding a son or daughter to the grant deed will make it easy for them to take over the property upon passing. Well, the first problem with that is it can cause a property tax reassessment. So doing so, this could likely trigger a reassessment of 1/2 of the property tax basis, especially if the son or daughter isn't even living in the property. So this could result in significantly higher property taxes. The other potential problem that this can create is a potential IRS or credit problem. So if the son or daughter has an IRS problem and they don't or can't pay their taxes, then their tax problem just became your tax problem. And if you wanted to sell and they still had an IRS lien when you sell, then that would have to be paid at the close of escrow. On the credit side, if they have a bankruptcy, then the credit company can also file a lien on the property as well. And of course, lastly, if you ever want to sell the property, they would also have to agree to sell it. And if they don't, well, then you can't. On the other hand, a trust can solve this issue, so it allows the parent to convey the property to the son or daughter without any potential problems mentioned previously. So if you're curious about the tax issue of an inherited property, then I suggest watching my video on taxes on inherited property. Otherwise, before we compare the 2 ways, let's explain a couple of terms used. First is what they call cost basis. Now, cost basis in real estate is the original purchase price of a property. The other term used is stepped up basis. And the stepped up basis in real estate is the fair market value of a property on the date of the decedent's death. The benefit of the stepped up basis is that it can significantly reduce capital gains tax owed by the recipient. So let's take a look at the potential tax problem when you compare joint tenancy versus community property. Let's take a look first at joint tenancy example. First, let's say husband and wife bought a house, let's say 20 years ago for $400,000. The husband passes away and the home's value at the time of death is $2 million. Now, the wife decides the house is just too big and decides she wants to sell it for $2 million. So the question is, what is the capital gain or profit on the house? So in this example, the husband passed away. So his half gets a stepped up basis to $1 million. The wife is still alive and they bought again the house for $400,000. So her half of her cost basis is $200,000. So the new basis is now $1.2 million. So when calculating the capital gain, we take $2 million minus the $1.2 million. The result is $800,000 of capital gain dollars. Now, the wife would be able to use the principal residence rule, which allows a single person up to $250,000 exclusion. So that would drop the capital gains amount to $550,000, which is still a sizable number on the capital gains tax. The good news is there is a way to avoid paying all of the capital gain example. Let's compare this to community property as a married couple. Now, as a married couple, you can hold title on your home as community property, and there's two types of community property. There's community property and community property with the right of survivorship. So the difference is in community property, a spouse can will his or her half interest. Now, this could be because both spouses remarried and want to will their interest to their kids. Whereas community property with the right of survivorship, the surviving spouse owns the property in its entirety. So if you want your husband or wife to have the property, then you should choose community property with right of survivorship. All right, so let's compare this with the same tax example that we used earlier when we had $800,000 capital gains under joint tenancy. So in community property, when a spouse passes away, you get a double stepped up in basis, which means both husband and wife's portion receives a full stepped up basis. So using the same example of a home that was purchased for $400,000, husband passed away, and the value of the house at the time, again, is $2 million. The wife decides to sell the home for, again, $2 million. The husband's half gets a stepped up basis to $1 million, and the wife also gets a stepped up basis to $1 million as well. So in this example, there is zero capital gains on the $2 million house sale. Now, in addition to the stepped up basis, the wife also qualifies for the principal residence exclusion of $250,000 on top of the $2 million. So if the wife chooses to sell the house a few years later for $2.25 million, she would be able to take the advantage of the principal residence exclusion and still have no capital gains tax. So, for tax reasons alone, community property has a huge advantage over joint tenancy. Now, you may be wondering if I should even bother putting the property in a trust if we hold title as community property. Well, the reason is when both spouses pass away and there is no trust, then the property has to go through probate. The probate not only costs the heirs about 5% of the sale price of the home, but it also takes 9 to 10 months for the probate to settle, assuming no one in the family objects. And having a will does not avoid probate. And the trust will usually cost about $2,500 to $3,000 for a typical living trust. So at some point, you may want to consider seeing an estate planning attorney who can set you up in a trust and put everything under community property. Now, my client bonus. One of the ways I can serve my clients is by providing an estimate of value of a property for a spouse's passing. So if you have a spouse that has passed away, even if it has happened 10 years ago, I'm able to go back in time and find comparables to determine the value that you can provide your CPA to obtain a stepped up basis in value. Otherwise, if you've enjoyed this video, be sure to hit the like button. Thanks.